Most traders stare at charts, but they don't have any idea how market actually works. Because candlestick, they just show you the price, and indicators are only lagging, and they just show you what's happened already. But market profile shows the intent of the market, what's really happening at that particular time. Market profile doesn't predict the market, it explains what's happening in reality. It shows you where the real business is happening and where the price is rejecting instantly. Instead of guessing tops and bottoms, you start reading acceptance and rejections. That's the difference between gambling and professional trading. When you understand value area, point of control and access, you instantly know where smart money is active and where retail traders get trapped. Most traders, they don't lose because they are wrong, they lose because they trade without a context, and market profile give you that context. So it tells you when to push and when to fade and when to stay completely out of the market. It's not an emotional base setup, but it's a structure based analysis. And this is why professional, they don't depend on indicators, they depend on auction logic. They trade the value and not the noise. Market profile isn't a strategy, it's a way of thinking. Once you see the markets this way, you can't unsee it. If you want to stop guessing and start reading the market, this webinar is for you. So please pay close attention and try to grasp as much as you can. So let's start. So let's just come to the main point, that like how to start market profile, and if you are a complete beginner, how to approach it. So I've divided it into some basic parts, so it's more easy for a complete beginner to understand and observe how this thing works. So today we will start with the level 1, and there is some things we're gonna learn today about auction market process and basic of market profile charts, and also how to read a TPO and basic profiles. And then further in coming days we will be moving on the next levels. So first thing we need to understand about auction market process, how market really works. Market is always in one phase. Either it's in a balance phase or otherwise it's in imbalance phase. You must have noticed in the charts that either markets are in the range or otherwise they are trending. There are only two phases, but we divide that two phases into three phases. So market operates like an auction. Buyer and sellers continuously negotiate the price. When buyers are willing to pay higher, prices moves up, and when the sellers are willing to accept lower prices, market moves down. The goal of the market is price discovery, to find the level where most participants agree the price is fair. When that fair price develops, the market goes into balance and consolidation. When participants no longer agree in the value, the imbalance appears, leading to directional movement we call as trend. So the auction process isn't random, it's simply the market trying to find its value. So there are these three phases of the market. Either markets are in balance phase, after balance, next phase is imbalance, and when markets are on imbalance phase, they try to create new balance. So this is a never ending loop cycle of auction market and market price data. So what is a balance philosophy? Balance is not random, it's auction logic. It's just like a bell curve. The market naturally concentrates trading around the fair value. Market profile reveals the structure in real time, allowing us to see where the market accepts the price, which we call value, and where it's reject the price, which we call imbalance. This is a basic bell curve in front of you. Most of the time, price try to create a balance. So the area where market have spent most of the time, which we according to the bell curve distribution, we say it at the 70% of time, we call it as a balance area, or we call it as a value. So there are some basics of TPO charts which we need to know before learning how to read the market profile charts. So some basic terms are, first we need to know what is TPO. TPO means time, price and opportunity. Each letter in this graph represent time spent at a price. How much time does that market have spent in that particular price? One box tell us that. One period is a specific time unit in the profile. Each period is assigned a letter. Each of this period of A, B and C defines the particular traveled and time spent in that particular selected time intervals, which we call periods. Usually it's 30 minutes. And then we come to value area. What is a value area? Value area is the price range where 70% of the trading activity occurred of that particular day or particular time being you've been watching. And then we have value area high. This is the upper boundary of value, the highest price of that 70% of the value area. And then we have value area low, VAL, which is the lower boundary of the value area, which is the 70% of the initial area where most of the transaction happened. And then we have POC. POC means point of control, or you can say price of control, where most of the transaction happened, or we can say most of the time market have spent in that particular auction day. So this whole 70% area where market has spent most of the time is all known as value area. And then we have initial balance. Initial balance is first range established during usually the first 1 hour. So the first 1 hour in this scenario, each period is 30 minutes. So the A and B combined, the low and high of that first hour range is marked as an initial balance or an initial start of the auction process of that day. So IB is a short form. IB means initial balance. And then we call a range. Range means the total high and low movement of the session of that particular day. What was the highest and lowest price? The whole area of that price is known as a range. These are some basic of TPO charts terms we use and we look at then to build our context. So how we use the value areas? Some basic terms for complete beginners. Markets are always auctioning. Either they are auctioning higher prices or lower prices according to the market sentiment and buyers and sellers intent. So value area, if the value is shifting higher, it means 70% of the auction price of the days are auctioning higher values, which indicates that prices are bullish, which means that it is a bullish intent, that buyers are accepting higher values, so the prices are bullish and we are going up and higher prices are accepted. If value area is going sideways, it means that market has created a balance in which buyers and sellers are equally contributing and equally participating, which ends up in a fair value or a fair balance of the particular period. So when the values are going down, suppose after 3 days, 4 days of balance, suddenly you get an imbalance due to any fundamentals or any other reason, market are establishing lower levels, which means the sellers are willing to participate in the lower prices. So the values are going down, which indicates us that okay, now the prices are being accepted lower by the sellers, which indicates that prices or market is weaker and sellers are getting aggressive with their sells and buyers are not interested anymore to buy at the higher prices. So the value shifting down, basic assumption that prices are going down, which means it's a bearish market. Now we come to some important points of market profile, which we call profile anomalies. So what are profile anomalies? Profile anomalies are irregular or incomplete structure formation in a market profile that indicate the auction process did not fully finish its job or is discovering value. These anomalies represent imbalances, rushed moves, emotional trading, or unfinished business in the market. They are structural imperfections that suggest the market may later return to repair or rebalance or complete that area. So what are the common types of anomalies? They are single prints, they are poor highs and poor lows. Then there is excessive fat areas, we can wide nodes, then we have excess areas, and also unfinished auction, no proper tail and extreme. These are some common type of profile anomalies and terms used. So why anomalies matter? They indicate areas where market participants showed emotion, urgency or lack of agreement. Markets often revisit or repair anomalies before establishing long-term directional conviction. They are useful cues for anticipating future test levels, support resistance and trade setups. So now coming to the anomalies. What are the anomalies? We call the tails in profile. They are tails, also known as axis. Tails are single prints, one TPO wide area that form at top or bottom of a market profile. They show that the market tested an area but immediately rejected it, meaning price was not accepted by opposite party. So there are two types of tails, buying tail and selling tail. So in the buying tail at profile bottom, there is a strong buyer response. We call it as a support rejection. This indicates that prices were trying to auction lower, but it was not accepted by buyers and they create an imbalance, quick rejection to the opposite direction and did not let the price come and revisit that area, which shows strong buying intent, immediate rejection, and price was not accepted by the opposite party. So buying excess at the bottom shows strong buying response, and selling same is selling tail at the top, means selling excess. It shows us that there is a strong seller response, resistance rejection, and price was not accepted by the opposite party. Simple as that. These are called tails, single prints, single TPO. Now we come to the single prints. They show area where the market moves quickly through a price level with little or no trading, usually due to strong buying or selling interest. Show market conviction. A single print suggests a strong directional move with minimal hesitation at the price. So what's happening is price move quickly through that particular area where there was very little or no trading happen in that particular zone, also known as imbalance. This shows it. This happens usually when there is a very strong buying or selling interest, which creates this imbalance. A single print suggests a strong directional move with minimal hesitation at that price. It shows that impulsive move, impulsive conviction. So there are some key points about the single prints. Indicate imbalance. They show price areas where the market moved quickly through a price level with little or no trading, usually due to strong buying or selling interest. Second point, commonly occur in the IB. The first hour of trading often creates single prints, forming the IB range. Third point, act as support and resistance. Single print areas are often revisited later as the market corrects or tests the imbalance and the anomalies as we discussed. And also, they show market conviction. A single print suggests a strong directional move with minimal hesitation in that price. So strong directional conviction. So these are the single prints. If you have a single prints and also we are extending downward, this indicates the strong selling conviction. If we have a single print and prices are auctioning higher, it means that there is a strong buying conviction. Then we have poor highs and poor low. Poor high, the upper extreme of the market profile, where the market reached a high but do not spend much time. The area is thin or has single prints. Poor low, the lower extreme of market profile, where the market touched a low but quickly moved away, again leaving a thin or single print profile. They often consist of single print or very few TPOs. Indicates lack of acceptance at that level, typically occurs after first move or imbalance in the market. Poor high likely to act as resistance in the future, poor low likely to act as a support in future, but then you can't just directly mark them and use that support resistance. They are just the reference points. The market often revisit these levels to fill in, so you can use them as a target. The market often revisit these levels to fill the single prints before continuing the original direction. So they can be used as a reference point. So trading with market profile. Trading with market profile is not a setup or fixed base setup or rigid price action strategy that you follow blindly. Market profile is a contextual decision making framework. To trade effectively using MP, we just observe the market structure, interpret the auction behavior, align the evolving data, understand the market, what is they trying to do, and confirm whether is it succeeding or failing in whatever thing is trying to do. Market profile help us to read the intent, participation, imbalance, and value development, not the patterns. The trade comes after context is built, not before. So I hope you understand the basic concept of market profile with this video. Surely in the coming future, we'll be making more detailed, beginner-friendly webinars so that you can learn how you can implement using the context of market profile. So I hope this video was useful for you all. And if you like the video, and also comment down if you have any further questions. You can join our community. The link is in the description. Hope to see you soon. Goodbye.